SCHD just announced a 3-to-1 share split. Not every day do you hear about an ETF splitting its shares, but SCHD just did it. And in today's video, we're going to talk about a couple of things. Number one, what does this mean for SCHD? And number two, is now the time to load up on this dividend favorite ETF? Before we dive in, show your appreciation. Click that like button down below. Subscribe to the channel, and let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, so the latest news to break, which came as a shock to some investors, was the fact that SCHD and a number of other Schwab ETFs are splitting its stock. SCHD is doing a 3-to-1 share split. As you can see on your screen now, Schwab announced splits for a number of their ETFs. And for those of you not aware of what a stock split is or what they do, they are more of an administrative update than anything else these days. There's no direct impact to the value of the ETF or if it's an individual stock. Let me show you what I mean. Let's say company A trades at a stock price of $600 per share. That's a high price stock. And if we wanted to invest only $250 today, we would not even be able to buy one full share. In fact, not even a half a share of company A. This day and age, though, fractional shares have become much more popular, but not everyone has access, which is one reason we still hear about stock splits. Now let's say company A has a market cap of $30 billion. This is the overall value, and market cap is known as the street value of a company. So right now the company trades at $600 per share and has a market cap of $30 billion, which means the company has 50 million shares outstanding, because the way that you get market cap is stock price times however many shares are outstanding. So if company A announces a 3-to-1 stock split, very similar to what SCHD just did, what does that mean? Well, the stock price will be cut by a third, which would bring the price down to $200 per share. But now instead of having 50 million shares outstanding, the company would triple and have 150 million shares outstanding, 3 times what they used to have. So when we take $200 per share now and multiply it by the outstanding shares of 150 million shares, what market cap do we get? The same exact market cap we had before of $30 billion. So stock splits, again, are more of an administrative move these days than anything else this day and age, when fractional shares have gained more popularity across a number of different brokerages. So going back through the list I showed you earlier, you can see that, in fact, only one Schwab ETF is currently trading above $100 per share. So to hear about any stock split for any of these ETFs was a little shocking, to say the least. So once we dove into this a little bit more, it became a little bit more clear. And for those of you that trade on Schwab, Schwab does not allow fractional trading on ETFs. So given the fact that all of these, SCHD is a Schwab-focused, managed ETF for that matter, they wanted to bring the price down to make it accessible to all investors. If you are trading at $100 per share, you have to buy a full share if you are trading on Schwab. I trade on Fidelity, so if I wanted to buy a fractional share of SCHD, I can do that easily, but not if you are a Schwab account holder for right now. So it made a little bit more sense from that standpoint. But irregardless, we know it's administrative, we understand more about why they did it. Is now the time to load up on shares of our favorite dividend ETF, which is SCHD. I talked a lot about it during the beginning of summer, saying that over the past 18 months from that standpoint there, we had just 1 or 2 sectors leading the charge. That is not the sign of a healthy bull market. A healthy bull market is when you have at least a handful of sectors leading the charge, not just technology, not just consumer or communication services from that standpoint. And that diversification needed to happen to confirm a healthy bull market moving forward. Well, now if you look back over the past 3 months or so, what do we have? A lot more diversification. Technology is still working to a degree. Communication services is still working to a degree. But real estate has climbed up again. You're seeing a lot more sectors start to move. And when you have diversification, SCHD works almost every single time. The ETF currently trades at $83 and change, but come at market close on October 10th, that 3-to-1 stock split or share split will take place, meaning if it happened today, shares would be closer to $28 per share. The ETF currently has assets under management of $60 billion, and over the past 12 months, shares have climbed 19%. When investing in an ETF like SCHD, it offers so much, a diversified portfolio, but from a dividend standpoint, you get a unique blend of a higher dividend yield and fast dividend growth. Right now, you could see that they offer a juicy 3.4% dividend yield to go along with a 5-year dividend growth rate of 12%. And the SCHD ETF has paid a growing dividend for 12 consecutive years and counting. When you have an investment that can grow its share price, it offers a unique blend of a higher dividend yield and fast dividend growth. That puts the power of compounding into overdrive, which is something we like to talk about a lot on this channel. But is now the time to load up? And it's a little bit more difficult when looking at ETFs because you can't just put a valuation on an ETF, especially if the positions are constantly changing. And in the case of SCHD, they change every single year to a degree. Every March, we get a reconstitution. So what we're going to do now really quickly is go through the top 10 positions. And what we're going to do is look at least at the PE ratio. Where is the PE ratio for that stock compared to its 5-year average to get a little bit better sense of whether this ETF right now is a little overvalued, a little stretched, or maybe it's undervalued and we should be buying more of it right now. But first, let's take a look at those top 10 holdings, which you can see on your screen now include Home Depot, Verizon, BlackRock, Cisco Systems, Pfizer, Chevron, Bristol-Myers Squibb, Lockheed Martin, Texas Instruments, and Amgen. 103 total positions within SCHD, and these top 10 make up roughly 41% of the total fund. So let's take a quick look at each of these, beginning with Home Depot. Looking here, you can see analyst estimates for the next few years, and looking at the next 12 months, analysts are expecting EPS of $15.69 per share, which equates to a forward PE multiple of 25.3 times. When we compare this to their 5-year average of 22.7 times, shares do appear overvalued. Next, let's take a look at Verizon Communications, where analysts are expecting next 12 months EPS of $4.68 per share, which equates to a forward PE multiple of 9.5 times, slightly below their 5-year average of 9.9 times, so I would put this stock in the fair value camp. Next on our list is BlackRock, where analysts are expecting EPS of $46.66 per share next year, which equates to a forward PE multiple of 20.1 times, slightly below their 21 times 5-year average, giving this stock a slightly undervalued. Next is Cisco Systems, stock ticker CSCO. Analysts are expecting next 12 months earnings of $3.57, giving the company a forward PE multiple of 14.7 times, which is exactly in line with their 5-year average, making this stock fairly valued. Next on our list is Pfizer, where analysts are expecting the company to generate EPS of $2.86 per share, which equates to a forward PE of just 10.1 times, well below the company's 5-year average of 13.9 times, meaning this stock appears undervalued. The next stock on the list is going to be Chevron, one of the energy giants, stock ticker CVX. Analysts are expecting next 12 months EPS of $12.66 per share, giving the company a forward PE multiple of 11.2 times, which is below their 5-year average of 13.8 times, meaning this company right now appears undervalued based on this metric alone. Next on our list is Bristol-Myers Squibb, stock ticker BMY, operating out of the healthcare sector. Analysts are expecting next 12 months EPS of $6.99 per share, which equates to a very favorable forward PE of 7.2 times, well below their 5-year average of 9.1 times. Next on our list is Lockheed Martin, stock ticker LMT, where analysts are expecting next 12 months EPS of $28.28 per share, which equates to a forward PE multiple of 20.4 times, which is above their 5-year average of 16.6 times, meaning this stock appears overvalued at the current price point. And next is Texas Instruments, stock ticker TXN, where analysts have next 12 months EPS at $6.51 per share on average, giving the company a high forward PE multiple of 32.1 times compared to their 5-year average of 23.8 times. And next is Amgen, rounding out the top 10, stock ticker AMGN, where analysts are expecting the company to generate next 12 months EPS of $20.71, giving them a forward PE of 15.4 times, which is above their 5-year average of 14.7 times, meaning this stock appears overvalued at the current price point. So when you look at these top 10 positions, only 4 of them really appear undervalued. And that kind of makes sense given how much the market has pushed higher here lately. So for me in my portfolio, given the fact that I have a sizable position in SCHD, since it's a top 5 position in my portfolio, these are not necessarily levels I'm looking to add right now. I would hope for a little bit of a pullback before adding to my position and growing my share count, something I definitely want to do when it comes to SCHD. So with that being said, are you loading up on SCHD right now? Let me know in the comment section. Number 1, do you own SCHD at this very moment, at the time that you're watching this video? And number 2, are you looking to buy SCHD prior to the share split? I hope you enjoyed today's video. And if you haven't done so yet, please hit that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.